At exactly 9 a.m. on Monday, May 4th, 2026, the global financial nervous system underwent a violent synchronized spasm. On trading floors from Manhattan to London, the glowing green numbers that had defined the precious metals rally for months suddenly turned a deep, hemorrhaging red. Within a single hour, the collective consensus of the world's most sophisticated trading algorithms shifted. The war trade was over. The peace trade had begun. The catalyst was not a signed treaty or a diplomatic breakthrough in a high-ceilinged room in Geneva. Instead, it was a post on Truth Social. President Trump announced the commencement of Project Freedom, a mission described in the soft, non-threatening language of international aid. A humanitarian escort mission designed to liberate stranded commercial vessels from the choke point of the Strait of Hormuz. To the high-frequency algorithms that dictate modern price discovery, the semantics were clear. Humanitarian plus escort equals de-escalation. By the time the ink was dry on the digital announcement, the market had already moved. Silver plummeted 3.5%, collapsing from a Friday close of $76.71 to a staggering intraday low of $73.78. Gold followed the gravity, sliding 1.6% from $4,214 to $4,167. Even Brent crude, the lifeblood of global energy, recoiled from its 126 highs, retreating into a volatile range between 108 and 114. This was the buy the rumor, sell the news phenomenon executed with industrial efficiency. The rumor was a ceasefire. The news was ships moving. The result was a flash crash that wiped billions in paper value off the board in minutes. But as the dust settled on the morning's charts, a profound and terrifying disconnect began to emerge. A gap between the digital reality of the ticker tape and the physical reality of the Persian Gulf. The algorithmic mirage. We often speak of the market as a singular rational entity, but in moments of geopolitical volatility, the market is less an entity and more a mirror, one that often reflects what it wants to see rather than what is actually there. On Monday morning, the algorithms looked at Project Freedom and saw an open strait. They saw the risk premium, that extra layer of cost added to assets during times of existential threat, as a bubble that had finally burst. But what if the bubble wasn't the risk premium? What if the bubble was the peace itself? The core mystery of this Monday chaos lies in a simple, haunting question. How can the market price in peace at 9 a.m. when the principal antagonist of the crisis declares war by noon? While Wall Street was celebrating a return to normalcy, the head of Iran's National Security Commission, Ebrahim Azizi, was typing a response that would render the morning's gains irrelevant. He didn't call the U.S. mission a gesture of goodwill. He called it a violation of the ceasefire. This is the central paradox of the current cycle. We are witnessing a collision between narrative-driven paper markets and reality-driven physical mechanics. The algorithms are programmed to trade the headline, but headlines are often just shadows cast by much larger, much more dangerous objects moving in the dark. The stakes of miscalculation. The $73.78 print on silver isn't just a number on a screen. It is a diagnostic of a systemic miscalculation. In the world of high-stakes geopolitics, a miscalculation isn't just a bad trade. It's a spark in a room full of gasoline. The U.S. Navy is currently deploying guided missile destroyers and 15,000 service members into a waterway that Iran has officially declared a no-go zone for uncoordinated transits. Every algorithm on Wall Street saw Project Freedom and concluded that the crisis was over. They concluded that the Strait of Hormuz was effectively open because the U.S. military said it was. But a waterway is only open when the parties on both sides of the shore agree not to fire. By labeling the escort mission a ceasefire violation, Iran has essentially moved the goalposts of the entire conflict. This creates what we call a dangerous trap. If you are holding silver, gold, or oil, you are currently standing in the middle of a massive divergence. On one side, you have the financial media covering the humanitarian headline and the resulting price drop. On the other side, you have the military reality of 100 land and sea-based aircraft flying into a corridor where the rules of engagement just shifted. Is the risk premium truly gone, or has it simply been suppressed by a temporary wave of optimism? Why did the oil market, historically more attuned to the nuances of the Middle East, refuse to sell off as aggressively as the silver paper market? And most importantly, what happens when the 15,000 personnel of Project Freedom meet the new maritime regime of the Iranian Revolutionary Guard? The flash crash of Monday morning wasn't a resolution, it was a setup. To understand why, we have to look past the peace trade and into the cold, technical machinery of the Strait of Hormuz and the global silver vault. The market thinks it has escaped the labyrinth, but in reality, it may have just walked deeper into the heart of the crisis. This is the story of how a single word, humanitarian, convinced the world that the most dangerous waterway on Earth was suddenly safe. and why that conviction might be the most expensive mistake of the decade. We are not one step away from a resolution. We are one miscalculation away from an escalation that the paper markets are not remotely prepared to handle. To understand why a few words on a social media platform could trigger a multi-billion-dollar sell-off, we have to look past the ticker tape and into the geography of the world's most vulnerable choke point. The Strait of Hormuz is not merely a waterway. It is the jugular vein of the global economy. At its narrowest, the shipping lanes are only 2 miles wide, a microscopic gap through which 1/5 of the world's oil and a significant portion of its liquefied natural gas must pass every single day. When the market saw the announcement of Project Freedom, it didn't just see a military operation. It saw a release valve for a pressure cooker that has been screaming for months. Since the beginning of the Iranian blockade, the strait has become a graveyard of stalled commerce. There are currently 49 commercial vessels trapped within the corridor, carrying everything from crude oil to industrial machinery. More importantly, there are nearly 20,000 seafarers, men and women from dozens of nations, who have been effectively held hostage by a geopolitical stalemate. The announcement of Project Freedom was designed to break this paralysis. President Trump's framing of the mission as a humanitarian gesture was a masterstroke of semantic warfare. By focusing on the crews and the innocent vessels, stuck through no fault of their own, the United States attempted to strip the conflict of its military baggage. They weren't sailing in to start a war, they were sailing in to escort the stranded. But in the world of high-stakes diplomacy, there's no such thing as a purely humanitarian destroyer. The architecture of escalation. The sheer scale of the American commitment reveals the iron fist inside the velvet glove. U.S. Central Command, CENTCOM, confirmed that this is no mere Coast Guard patrol. The deployment includes guided missile destroyers, over 100 land and sea-based aircraft, and 15,000 service members. This force is augmented by multi-domain unmanned platforms, the cutting edge of modern naval surveillance. The stated logic is simple. We will use best efforts to get their ships and crews safely out. If in any way this humanitarian process is interfered with, that interference will unfortunately have to be dealt with forcefully. This is what the algorithms interpreted as the end of risk. The logic was that no rational actor would challenge a carrier strike group and 100 combat aircraft for the sake of a few tankers. The market priced in a scenario where Iran would grumble, step aside, and allow the humanitarian corridor to function. It was a bet on Iranian pragmatism, but that bet ignored the fundamental shift in Iran's strategic posture, the birth of the new maritime regime, the red line in the water. Within hours of the American announcement, the Iranian response dismantled the market's optimism with surgical precision. It didn't come in the form of a vague threat. It came as a formal declaration of a new legal reality. Ebrahim Azizi, the head of Iran's parliament's National Security and Foreign Policy Commission, issued a statement that should have chilled the blood of every trader on the COMEX. He declared that any American interference in the new maritime regime of the Strait would be considered a violation of the ceasefire. To understand the weight of that phrase, we have to look at the historical parallels. In the 1980s, during the peak of the Iran-Iraq War, the world witnessed the tanker war. At that time, the United States launched Operation Earnest Will, the largest naval convoy operation since World War II. The goal was identical to Project Freedom, escorting tankers through a hostile strait. The result of Operation Earnest Will was not immediate peace. It was a series of accidental escalations. Sea mines that nearly sank the USS Samuel B. Roberts, the destruction of Iranian oil platforms, and eventually the tragic shoot-down of a civilian airliner. The lesson of history is that when two massive military machines occupy the same 2-mile-wide lane, the margin for error disappears. Iran's new maritime regime is a claim of absolute sovereignty over a waterway that international law traditionally defines as an international strait for transit passage. By calling the U.S. presence a ceasefire violation, Iran is stating that the very act of the U.S. Navy existing in those waters is an act of aggression. They have successfully flipped the script. The U.S. sees an escort as a rescue. Iran sees it as an invasion. The great misinterpretation, this is the context that the financial media missed. And while headlines were trumpeting the opening of the strait, Iran's military central command was doubling down. They stated that any passage through the strait must be coordinated with Iranian forces under all circumstances. The market heard, the U.S. is moving ships, so the oil will flow. The reality was, the U.S. is moving ships into a corridor where Iran has explicitly forbidden them to go without permission. This is the sovereignty trap. If the U.S. Navy proceeds without Iranian coordination, they are, by Iran's definition, violating a ceasefire. If they wait for Iranian coordination, Project Freedom has failed before it began, and the blockade remains effectively in place. Why does this matter for the price of silver and oil? Because the market has priced in a scenario A, peaceful resolution, while the physical actors on the ground are moving toward a scenario B, forceful confrontation. The 15,000 U.S. service members are not entering a vacuum. They are entering a space where the rules of engagement are being rewritten in real time by a parliamentary commission in Tehran. The humanitarian label is a shield for the U.S., but for Iran, it is a target. They have signaled that they will not recognize the label. They only recognize the destroyers. The stage is now set for a classic Thucydides trap in a 2-mile-wide channel. As we move into the mechanics of the market, keep this in mind, the silver price dropped because the world thinks the humanitarian narrative will win. But the physical silver, the actual metal sitting in the vaults, is reacting to a world where the Strait of Hormuz is more dangerous tonight than it was a week ago. We are not watching a resolution. We are watching the most sophisticated game of chicken in maritime history, played with guided missiles and the global economy hanging in the balance. To understand why a silver price of 73.78 is a mathematical fiction, one must first understand the fundamental divorce between the paper market and the physical world. In the digital coliseum of the COMEX, silver is not a metal. It is a narrative. It is a derivative of a derivative, traded by machines that possess the processing power to execute 10,000 trades in the time it takes a human to blink, yet lack the wisdom to distinguish a social media post from a physical supply chain. On Monday morning, these algorithms performed what can only be described as a narrative arbitrage. They scanned the text of President Trump's Truth Social post, registered the keyword humanitarian, and immediately calculated a lower probability of war. In the binary logic of a trading bot, less war equals less risk, and less risk equals lower silver prices. But here is the technical reality the machines ignored. The price of silver is no longer determined by the cost of mining it, but by the desperation of those who need to own it. The 73.78 intraday print was a paper event, a temporary fluctuation in the digital shadow of the market. Meanwhile, the physical object casting that shadow remains in a state of unprecedented structural collapse, the arithmetic of depletion. While the paper price was retreating, the physical data remained stubbornly, almost violently, bullish. According to the World Silver Survey 2026, the silver market is currently entering its 6th consecutive annual deficit. We are not merely undersupplied. We are living through a systemic cannibalization of global reserves. The data is relentless. The projected annual deficit for 2026 stands at 46.3 million ounces. Since the beginning of this cycle in 2021, the cumulative drawdown of global silver stocks has reached a staggering 762 million ounces. To visualize that, imagine nearly 1 billion ounces of silver, representing years of global mining output, simply vanishing from the vaults to satisfy the unyielding appetites of the solar industry, high-end electronics, and the military-industrial complex. This is the meat of the silver essay. Silver is an industrial necessity with a precious metal's skin. You cannot build a guided missile destroyer, a drone swarm, or a high-frequency trading server without it. Yet, the market is pricing it as if it were a purely discretionary asset. The algorithms sold the narrative of peace, but they cannot print the 46.3 million ounces required to bridge this year's deficit. They are trading a ghost, while the physical world is fighting over the bones. The COMEX leverage trap. The most dangerous mechanic in play right now is the sheer level of leverage within the COMEX system. As of Monday, the July open interest sat at 74,536 contracts. In the sterile language of finance, that sounds like a manageable number. In the physical world, it represents 372.7 million ounces of silver, all of which carry a legal claim to delivery. Now, contrast that with the COMEX registered vault data, which shows only 80.8 million ounces currently available for delivery. This is a mathematical imbalance of nearly 5 to 1. If even 25% of those contract holders stand for delivery, demanding the actual physical bars rather than a cash settlement, the system reaches a breaking point. We have already seen the precursors to this delivery panic. In April, the market witnessed a record-breaking 23.7 million ounces delivered in just 3 days. The delivery buyers, the sovereign wealth funds, the industrial conglomerates, and the smart money insiders do not cancel their orders because a tweet mentions a humanitarian escort. They know that a guided missile destroyer in the Strait of Hormuz does not magically produce more silver ore in the mountains of Peru or Mexico. They are reacting to the vault drain, a phenomenon where silver is moving from eligible to registered, and then out of the system entirely, never to return. The narrative, half-life. Why, then, did the price crash? The answer lies in the concept of the narrative half-life. In a high-volatility environment, a narrative, like the Project Freedom peace trade, has a very short period of peak influence. It is a sugar high. The machines react to the headline, create a cascade of sell orders, and trigger the stop losses of retail investors. This creates a self-fulfilling prophecy of downward momentum. However, this momentum is decoupled from the cost of carry and the physical floor. A paper crash is essentially a transfer of wealth from those who trade the when, the timing of the news, to those who trade the what, the physical reality of the metal. The 73.78 price is the when. It represents a gamble that the Strait of Hormuz will be open tomorrow. But the $80.8 million ounces in the vault represent the what. It is the hard limit of reality. Consider the irony. The very U.S. Navy destroyers being used in Project Freedom are themselves massive consumers of silver. The military-industrial demand is one of the primary drivers of the 762 million-ounce drawdown. By deploying the fleet to lower risk, the U.S. is simultaneously increasing the physical scarcity of the metal. We are currently trapped in a loop where the paper market is attempting to price a resolution that the physical market knows is impossible. The algorithms are looking at the surface of the water, celebrating the arrival of the ships. But underneath, the current is pulling in the opposite direction. The physical demand for silver is a freight train with no brakes, and Monday's flash crash was merely a bird hitting the windshield. The question for the next 48 hours isn't whether silver is worth $73 or $80. The question is how much longer the paper market can maintain the illusion of liquidity when the physical vaults are sounding the alarm. In the mechanics of silver, price follows the metal, and the metal is leaving the building. When the price of silver gaps lower on a Monday morning, it is rarely just about silver. It is a signal, a high-frequency pulse traveling through the nervous system of global power. The Project Freedom sell-off is not merely a correction. It is a live-fire exercise in how the world perceives the limits of American hegemony and the resilience of the Iranian new maritime regime. The ripple effects of this moment extend far beyond the COMEX vaults. They touch the industrial heartlands of Germany, the energy-hungry hubs of East Asia, and the strategic reserves of every major superpower. We are currently observing a three-way divergence in how the world's most critical assets, oil, silver, and political credibility, are reacting to the same set of facts. This divergence reveals a global landscape where the peace, currently priced by Wall Street, is an increasingly lonely island in a sea of escalating risk. The three-scenario matrix: winners and losers. To understand the global consequence of this flash crash, we must analyze the three ways this confrontation resolves. Each scenario creates a distinct set of winners and losers, shifting the geopolitical plates in ways the algorithms are not yet capable of modeling. Scenario 1. The hollow consolidation. If the U.S. Navy successfully escorts the 49 stranded vessels out of the strait without a kinetic exchange, the market will call it a victory for the peace trade. Silver would likely consolidate in the $73 to $76 range, while Brent crude might drift toward $100 to $105. The winner? The U.S. Department of State. A bloodless escort reasserts the image of the U.S. as the guarantor of maritime freedom. The loser? The Iranian parliament. Their new maritime regime would be exposed as a paper tiger, a verbal threat that failed to stop the physical movement of cargo. The reality check. Even in this best-case scenario, the physical silver deficit remains at 46.3 million ounces. The price may consolidate, but the underlying supply-demand vacuum continues to pull the floor higher. Scenario 2. The kinetic contagion, the high-risk flashpoint. This is the scenario the market has priced at near zero probability. Yet, it is the one most clearly signaled by Iran's military command. An incident at sea, a mine detonation, a drone intercept gone wrong, or a misinterpreted warning shot, would shatter the Project Freedom narrative in a heartbeat. The consequence? Oil would immediately retest the $126 highs, and silver would likely gap through $80 within a single trading session. The loser, the paper traders. Every algorithm that went a risk-on Monday morning would be forced into a catastrophic unwind. This would be the hindsight entry moment of the cycle, where those who sold the $73 dip realized they traded a generational bottom for a truth social headline. The winner, the sovereign vaults. Central banks and physical accumulators thrive on the panic of the paper market, using the artificial dip to secure physical ounces that the COMEX can no longer easily replace. Scenario 3, the diplomatic mirage. The market is currently pricing. Scenario 3, a formal agreement where Iran and the U.S. coordinate passage. In this world, the war premium exits the market structurally. Oil drops to $95 and silver settles in the $68 to $72 range. The catch. Diplomacy requires two parties to agree on the status quo. Iran has spent the last 12 hours doing the exact opposite, declaring the U.S. mission a ceasefire violation. To price in Scenario 3 today is to ignore every official statement coming out of Tehran. The market is trading a hope, not a reality. The Brent signal, why oil is the anchor. In any geopolitical crisis, there is always a truth teller in the markets. In this cycle, it isn't silver, it's Brent crude. Oil traders possess a more direct, more visceral exposure to the Strait of Hormuz than silver algorithms. While silver was being smashed by paper selling, Brent crude held a significant portion of its value, stabilizing in the $108 to $114 range. If the oil market truly believed the strait was open and the humanitarian mission had succeeded, Brent would be trading at $95 right now. The fact that it remains above $107 tells us that the smart money in energy is not buying the peace narrative. They see the 15,000 U.S. service members not as a sign of resolution, but as more targets in the water. This creates a massive risk gap. Silver algorithms are front-running a piece that the oil market, the very market most affected by the strait, does not yet see. This gap is where the current danger lies for silver holders. If oil begins to creep back toward 115, it will serve as the leading indicator that the silver flash crash was a trap. The geopolitical shift, the death of coordination, the most profound ripple effect is the formal breakdown of the maritime status quo. By declaring the U.S. presence a violation of the ceasefire, Iran has moved from a tactical blockade to a strategic challenge of international maritime law. For decades, the U.S. Navy operated under the assumption of transit passage, the idea that warships could move through international straits without coordination. Iran's new maritime regime explicitly demands coordination. If the U.S. Navy ignores this demand, they are, in Iran's eyes, operating outside the law. If they comply, they acknowledge Iranian sovereignty over the world's most important waterway. This is a geopolitical checkmate attempt. It turns every commercial escort into a potential act of war. The ripple effect for silver is that the geopolitical risk premium, the war tax on precious metals, is not a static number. It is a fluctuating variable tied to the probability of a miscalculation. Today, the paper market decided that probability was zero. Tomorrow, the physical world might remind them that the probability is, in fact, higher than it has been in 40 years. We are watching the global order being renegotiated in the middle of a 2-mile-wide channel. The Monday chaos was just the opening bell. The real movement happens when the first U.S. destroyer crosses the invisible line of the Iranian regime. Until then, the market is simply holding its breath. And $73 silver is the sound of a market that has forgotten how to exhale. In the high-stakes theater of global finance, there's an old adage that the market can remain irrational longer than you can remain solvent. But there is a corollary to that rule. Reality can remain ignored by the market only until the first shot is fired. As we stand at the precipice of Tuesday's market open, the Monday chaos has left us with a haunting image, a world where the paper price of silver is sprinting toward a dream of peace, while the physical reality of the Strait of Hormuz is walking calmly into a nightmare of escalation. The final verdict on the silver crash is not found in the red candles of a trading chart, but in the widening chasm between what we believe and what we can prove. To hold silver in May 2026 is to participate in a grand experiment regarding the nature of value itself. Is value a consensus reached by algorithms in a fraction of a second? Or is value the physical existence of a strategic metal in a world that is rapidly running out of it? The architecture of the mispricing. The core of the Monday trap is a fundamental error in probability. Currently, the paper market is pricing scenario 3, the diplomatic resolution, with nearly 90% confidence. It has fully digested the humanitarian narrative of Project Freedom and discarded the war premium as if it were a spent fuel rod. Yet, every piece of verifiable data from the last 12 hours suggests we are actually living inside the probability range of scenario 2, the incident at sea. Consider the misalignment. On one hand, you have a Truth Social post and a market-wide risk-on sentiment. On the other, you have the head of Iran's National Security Commission officially declaring the U.S. presence a ceasefire violation. In the grammar of geopolitics, a ceasefire violation is not a polite disagreement. It is a legal and military justification for kinetic action. The market has priced in the intent of the United States, but it has completely failed to price the response of Iran. This is the definition of a narrative bubble. It is a beautiful, fragile consensus that depends entirely on nothing going wrong in a 2-mile-wide channel filled with 15,000 American service members and 100 combat aircraft. If a single drone intercept fails, or a single mine detonates, the peace trade doesn't just correct, it disintegrates. The vault's silent testimony. While the algorithms were panicking on Monday morning, the comics vaults remained eerily silent. They are the ultimate truth-tellers in this essay. They do not read social media. They do not react to the semantic nuances of the word humanitarian. They only know the physics of inflow and outflow. The 80.8 million ounces in the registered vaults and the 762 million ounce cumulative drawdown since 2021 are the gravity of this market. You can suppress a price with paper contracts. You can sell 372 million ounces of digital silver that doesn't exist. but you cannot use digital silver to build a solar panel or a cruise missile. The record April delivery of 23.7 million ounces in 3 days serves as a warning shot. It tells us that the smart money, the industrial buyers and sovereign entities, is no longer looking at the ticker. They are looking at the exit signs. They are standing for delivery because they recognize that in a world of new maritime regimes and broken ceasefires, a silver bar in the hand is worth infinitely more than a contract on a screen. The 48-hour window. The window between Monday night and Tuesday's opening bell is perhaps the highest risk period silver holders have faced in this entire cycle. The U.S. military is in the strait right now. The escalation is not a future possibility. It is a current operational reality. If nothing happens by Tuesday morning, the market will likely consolidate. The $73.78 intraday low will be tested, and silver will settle into a range of $73 to $76 as it waits for Project Freedom to prove itself. But if an incident, however small, occurs overnight, the $73.78 print will be remembered as the hindsight entry of the decade. The market would be forced to reprice months of risk in a matter of hours, gapping up toward $80 as the realization sets in. The peace trade was a hallucination. Philosophical conclusion: the price of peace versus the reality of war. We often confuse the market with the world. We assume that because a price goes down, the danger has subsided. But, as we have seen in this analysis, the price of silver is currently a measure of human optimism, while the supply of silver is a measure of physical exhaustion. The final verdict is this: the data has not changed, only the mood has. The 46.3 million ounce annual deficit is still there. The sixth consecutive year of supply shortfall is still there. The 15,000 U.S. personnel in a hostile waterway are still there. The market priced peace at 9 a.m. because it was tired of the war. It was a psychological capitulation disguised as a financial one. But geopolitics does not care about market fatigue. Iran's new maritime regime is a structural challenge to the global order, not a temporary headline. Tonight, as the world sleeps, the crews of 49 stranded vessels and 15,000 U.S. service members are waiting for the sun to rise over the Strait of Hormuz. They are the ones living the reality that the algorithms are trying to guess. For the silver holder, the message is clear: ignore the noise of the paper flash and watch the mechanics of the vault. The Monday chaos was a trap designed to shake the conviction of those who trade the news. But for those who trade the data, it was a reminder that in an age of digital illusions, physical scarcity is the only ultimate truth. Whether silver sits at $73 or $83 on Tuesday morning, the underlying story remains the same. A world that requires silver to function is running out of it, and the waterway that controls its flow is on the brink of a firestorm. The peace is a rumor. The deficit is a fact. The vault knows the difference. See you on the other side.